Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. A range of macro, micro, policy, political, and geopolitical headwinds have caused acute weakness in financial markets so far this year. Uncertainty around macro outcomes have fed into the concerns of systemic risks, which in turn increased cross-asset correlations, causing most assets to fall together. Looking ahead, while some of the micro, political, and geopolitical headwinds are likely to simmer in the background, macro and policy drivers are likely to take over as the most important drivers of financial markets. Here, as we've been arguing, it is the appropriateness of the monetary policy response to the evolution of the growth inflation mix that matters most. Given the recent hawkish tone of the central banks, especially the US Fed, markets have worried that central banks might tread the rate hiking path without acknowledging downside risk to global growth. Indeed, some of the comments from the central bank officials over the past few months have sounded that way. Looking ahead, as growth slows in the US and a possible recession hits Eurozone and the UK, markets are hoping that central banks will eventually pivot. A pivot could mean different things to different people. But for us, it is the notion that monetary policy will eventually react symmetrically to growth and inflation risks. Now, for investors, three questions come up. What is the outlook for inflation? What's the outlook for growth? And how should investors position? Firstly, on inflation, it has recently hit a multi-decade high across developed markets. But there are initial signs of a sharp slowdown in inflation emerging. Starting with commodity prices, the actions of the US Fed so far this year have resulted in the US dollar squeezing higher. This has caused the deflation in commodity prices, which have fallen sharply from their June peak. Retail consumption trends remain strong, but inflation expectations of consumers have remained well anchored and in some cases have recently fallen. Housing and rents contribution to overall consumer price inflation in the US has been high in recent months, but we know that this component responds to the monetary policy tightening with a lag. Moreover, some of the alternative high-frequency data for rents in the US has started to point to a strong moderation. For businesses, some of the recent surveys point to lessening cost pressures. Relationship between wages and inflation is more complex, and hawkish comments tend to ignore the importance of potential improvement in productivity. Market expectations of inflation, as measured by break-even rates, have fallen sharply so far this year. Overall, we expect inflation to moderate strongly in the year ahead. In fact, strong disinflation and even outright deflation in certain sectors is the key risk for financial markets in 2023. This should make the Fed pausing or slowing its rate hikes a more likely scenario. Moving on to the growth is undoubtedly slowing across the world as expected, and this should support a central bank pivot as inflation expectations remain anchored. For the global economy in aggregate, we stick with our view of an asynchronous mid-cycle slowdown. In Europe, a recession looks more likely in the next 12 months. In Asia, recession probabilities are the lowest, with China and Japan yet to realize the operational leverage gains from the post-pandemic reopening. In the US, recession probabilities have certainly risen, yet an outright recession looks less likely. Now, against this backdrop, how should investors position? As central bankers go on a tightening mode, they need to keep an eye on the evolution of growth and inflation data to determine the appropriate interest rate level. Given the pace of policy tightening, it's easy for central banks to miss obvious signals that they've done enough. This would account for a policy error. Until there is a confirmation that policy error will be avoided, financial markets are likely to remain volatile. However, the case for a central bank pivot is strengthening, and this is positive for risk assets. Yet we believe it is a bit early to position for this. For now, investors should have a pivotal patience and wait for an appropriate time to re-risk. In terms of asset allocation, we remain overweight cash awaiting opportunities, neutral equities and alternatives, and underweight fixed income. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. This is Kishore Muktinutalapati signing off.